Welcome to Meet the Visionaries podcast hosted by MIT Center for Real Estate. My name is Cherry Tang, and I'm a current Master of Real Estate Development student at the center. Today's guest is Eric Plesman, the President and CEO of Oxford Properties, the global real estate arm of OMERS, the pension plan for over 640,000 Ontario municipal workers. With approximately 63 billion Canadian dollars, or roughly 46 billion US dollars in assets under management across North America, Europe, Australia, and Asia Pacific. Oxford is behind some of the world's most ambitious projects, from Hudson Yard in New York to the redevelopment of London Stock Exchange headquarters in London. Eric started his real estate career at Morgan Stanley before joining Oxford in 2011. Rising to EVP of North America, he then led the global real estate platform at HOOP, the healthcare of Ontario pension plan, before returning to Oxford as CEO in late 2025, making him one of the rare executives to have led two institutional real estate platform at Canadians' major pension funds. Eric, welcome to the show. I have to say, as a fellow Canadian, it's great to have someone back home on the podcast.
It's fantastic to be here, and honestly, it sounds way more impressive when you say it than I said it. So thank you.
Well, it's an honor to have you. And speaking of Canada, since we're both Canadian, I wanted to start with something that's been making headlines back at home. OMERS CEO Blake Hutchison recently announced that a new target to increase OMERS Canadian allocation to 25% of the total portfolio, up from 18% today. That's committing at least 10 billion Canadian dollars in new domestic investment in the next 5 years. So curious to hear your thoughts on how that domestic mandate change how you allocate capital going forward at Oxford.
Yeah, no, it is. It's a great question, and it honestly is. It's invigorating for the team. I would say, from our perspective, I probably need to beat off the infrastructure group who wants to have more of that 10 billion for themselves than it may be for real estate. But we honestly believe there's a tremendous real estate opportunity in Canada, and so I wouldn't say that it has necessarily changed anything. We continue to be very active in Canada. A third of our portfolio is there today. We've got 1,000 people of our 1,300 people at our organization in Canada, and we've got an incredible platform. So to be honest, we are one of the ones that will be driving some of those investment opportunities, and I've been pretty laser focused with the team to try and unearth those.
And speaking of investments back at home, I'm curious to hear if there is a different return threshold or risk tolerance for domestic deals versus when you're looking at international deals.
Yeah, I'm not sure there is on a net basis. Yeah. I would say the difference is that what goes into that return. And so by virtue of the fact that we pay taxes in other jurisdictions, we may not have the same financing advantages that we have in other jurisdictions. So that in and of itself requires us to target returns that are a little higher to account for what may be that leakage. But that is really that's probably the biggest area where we have to keep that in consideration in terms of what those increased returns may be. But fundamentally, we're looking for similar type of product in each of the different geographies, and the question just becomes, thematically, how do we look at it, and then regionally, how do we look at it based on those thematics?
Great. Well, thank you for that response. And I want to talk a little bit about U.S. platform. Right now, it accounts for 40% of the global portfolio, and you've just brought in Sarah Queen, who's led the 38 billion real estate platform at MetLife to run the platform. So where do you want to take the U.S. platform in the next 5 years?
Yeah, so that 40% is really comprised of both our equity book as well as our credit book. And our credit book has perhaps been the most active over the past 2 to 3 years, just because we saw that as being the best risk-adjusted returns in everything that we were looking at. I would say geographically, it is largely in line with where we stand today. So I'm not sure that we are necessarily growing any part of our book dramatically more. Canada will probably come a little bit higher based on the conversation we just had. Yeah. But, I think the U.S. is really at the level that we will continue to have it at on a percentage basis. The beauty of the plan is the pie continues to grow. So as we continue to perform, we have an allocation of a certain amount related to that overall portfolio. And so, and we're active recyclers of capital, and that will drive incremental capital available for the various strategies. So, in aggregate, I expect the percentage will be around the same. Okay. The question just becomes, how do we toggle between credit and equity, and that's really a function of where do we see the opportunity set.
Thank you for that response. I think that's very helpful context, and I think that sets up the stage for the rest of our discussion here. I kind of want to take a step back and talk about maybe the beginning of your career. You started your real estate career at Morgan Stanley, and you spent 10 years there. You rose from analyst all the way to executive director. I'm curious to hear if there's any lessons or takeaways from banking that you brought to the pension fund world.
Yeah, well, honestly, I've been really blessed to have, what's been a remarkable career, and now to be sitting in the seat that I do today.
Yeah.
I started at Arthur Andersen not doing real estate. I went over to Morgan Stanley in London, and the honest answer is real estate was never on my radar. I had joined before the tech bubble burst. I was in analyst training, and they asked me, what are the 3 areas that you'd like to go into? And I said, tech, telecom, or M&A. And a week later, they said, you're going to real estate. Oh. So I was shocked. I actually viewed myself as a finance first, real estate second when I first started in the business. But honestly, I just got the real estate bug, and it quickly ended up becoming more about real estate first and finance second. But what that experience showed me was that's probably where I really ended up honing my work ethic and refined my chops in investment banking. It was the core fundamentals that kind of served me throughout my career. And so the rigor and the analytics was an incredible area to kind of get that experience, because not only did I have the opportunity to do investment banking where I was on the advisory side, but Morgan Stanley was also a preeminent real estate investor. And so I worked on the principal side of the business as well. So having worked on both sides, that really helped develop a lot of the skills. So I could do everything from, deconstructing a REIT's balance sheet or a real estate company's balance sheet and income statement to underwriting a single asset acquisition. And that, helped me think of things quite differently and had a better appreciation of capital markets, which served me better both in the roles all the way through Oxford, and then also as I was at Hoop, and then in returning to Oxford. And so, it's been an incredible run, but it's with a fair amount of twists and turns.
Yeah, for sure. And I guess on that note, you left Oxford for Hoop and to build out their global real estate platform.
Yes.
So what drew you back to Oxford again?
Yeah, leaving Oxford was an incredibly difficult decision, because I had achieved the 2 things that I've always told my teams that they should be striving for, which is you have to love what you do, and you got to love who you do it with. And I had that at Oxford. The opportunity to go to Hoop was to move from a team of 1,000 people that I had at Oxford to a team of 15 that I then grew to 28 people. But it was a fundamentally different investment approach, because I went from being at a vertically integrated real estate company and the arm of this pension plan to being an investment allocator. And so the way in which we would invest was very different. The decision to come back was very easy for me, because it was a team that I knew, it was a platform that I had a huge amount of regard for. It had a leadership team that I was, both at the Oxford level and at the OMERS level, excited to return to. And my view was that in this next stage of the real estate cycle, it's those in the box skills that are going to help us outperform a number of our peers. So having the vertically integrated leasing, asset management, development, investments, and operations is going to be critical in my mind to the success of us going forward.
Well, I think that's a great segue, because I want to dig into what actually makes Oxford's model different from the rest. Yeah. As you know, real estate investors and developers, they raise capital from LPs, and they operate on a very defined fund timeline. Yes. Oxford is very different in the sense that it's wholly backed by OMERS long-term pension capital. So how does that change the way you invest, whether that's like competing for a deal or you're underwriting for a development or deciding to hold assets during market downturns? Yeah,
well, I would say, the permanent capital structure isn't just a balance sheet advantage. It actually fundamentally changes the way that we look at things. So, and I'll start with this context. So we have permanent capital because, as you said, we have a mandate to act on behalf of our pension plans. We represent 665,000 pensioners in the province of Ontario, including my mom, actually, who's one of the pensioners. That helps hit it home.
No pressure.
Certainly, no pressure. It'll make Christmas dinner very awkward if we don't do well. But it genuinely requires a long-term horizon, right? And it gives us the opportunity to kind of make the best investment decisions at the end of the day. We don't have structural pressures like others may. So we don't have to face redemption issues like open-ended funds may have. We don't face strict investment periods that closed-ended funds may have. We don't have windows of trading at discounts or premiums to NAV that help drive the activity that a REIT may be involved in. And so for us, it actually means that we have a counterparty or a stakeholder that's involved. That is a $106 billion fund sitting behind us, which means that through a downturn, we can hold those assets. We're not pressured into selling. It means that, in development, we can be selective yet courageous in what we decide to move forward on and where we have the most conviction. And if we don't find the opportunities that we're looking to invest in, we simply don't invest. We don't have annual investment or deployment targets.
Okay.
We invest on the basis of where do we find the opportunity, and the fund will otherwise figure out where to invest that capital. I don't have dead cash sitting on a balance sheet. The fund simply decides to invest it elsewhere in order for that to create the return.
Well, I guess maybe a counter to that is like, obviously pension capital described as patient capital, right? So
Yes.
Has there been any instances where that patience kind of worked against you in any sense?
I don't know if it's necessarily worked against us. I think one of the things that I'm always conscious of is, and a COVID helped crystallize this, you never know what's around the corner. And so don't confuse patience with feeling like you can sit on your laurels and not make active portfolio decisions that you otherwise have to do. I think that's one of the things that it's helped, make sure that we continue to push forward. So, we have this interesting portfolio that's a bit of a barbell. On the one end, for any Canadian listeners, we own this mall that's Yorkdale Mall, which is the best in the country. It's top 5 in North America. It's got almost $2,400 a square foot in sales productivity. It's at 16 million customers that come through it. It's an incredibly impressive mall, and we have these large master plans. Master plan plays like Hudson Yards or MTCC. We have that on the one end, and on the other end, we have this collection of assets. We have a portfolio of 650 assets. So we have a number of assets that we otherwise have where we're constantly trying to optimize value within, and we kind of take some of the proceeds from some of the capital that we may recycle there, reinvest into where we can create more value and do things. So, it's the patience allows us to actually maximize both pieces of it. But I think to the point I made earlier, what's important is for us to be active investors and recyclers of capital, because that's the best way in which to create return. And my team often hears this, that the best return is a realized one in many ways.
Well, speaking of returns, how does Oxford price the margin of safety when you're making these investment decisions? So
it is really going to be on the basis of what the business plan is. So we have different modalities of investing. So the modality will be like income producing assets, so IPP assets, development assets, credit strategies. Each of these will have a different return target that we kind of make an assessment on to determine whether that's a risk-adjusted return that we're looking to take on or not. And so I'd say that's probably the best way to articulate is like the buffer that we otherwise underwrite is really on the basis of what are we looking for from that specific opportunity, and therefore in executing that business plan, how much risk are we taking on, and are we getting priced appropriately for investing that capital?
Okay, that makes a lot of sense. And you kind of touched on this earlier, but Oxford described itself as a value-driven thematic investor. And currently, Oxford's portfolio spans across 4 different regions and many asset classes, including industrial, life sciences, residential, office, retail, hospitality, and the credit part of your business. So how do you allocate attention and capital across so many different market and business streams?
Carefully. So, I would say that the approach is quite tailored for the regions and to the capabilities that we have in those regions. We see our competitive advantage as being in the markets and sectors that we know really well. And so what we want to be able to focus our capital and attention on are the areas that we have a differentiated advantage. Yeah. And we recognize we can't be all things to all people. So it's hard for those that are, listening to this to see this visually, but if you think of an operating model spectrum, on the one end we have Canada, where it's 1,000 people, 65 years of experience, and we're vertically integrated across all asset classes. And on the other end, we've got Asia Pacific, where we've been for 8 years. We have 14 people on the ground. And then you have kind of the US that's in from Canada, and you have Europe that's one further in. And as you go further along that spectrum or that continuum over to Asia Pacific, the modality that I spoke to in terms of how we invest changes a little bit. So what we end up actually doing is utilizing platforms in a different way and investing through those platforms, because it's hard to kind of outlocal the locals. And so, I think that's one of the things that we've been quite conscious of, is just making sure that we're allocating according to what are the capabilities within each of those sectors and within those regions. And it's taking the learning that we've had in various regions and trying to think thematically, like, where are some of those asset classes earlier in terms of their maturation relative to what our experience has been in other regions.
Okay, that makes sense. And I would like to take that thematic lens and kind of apply it on development specifically. In your eyes, what makes a development opportunity institutional grade, and what are some of the non-negotiables for Oxford when you're looking at a development opportunity?
Yeah, I mean, development certainly is... location, I think is clearly key. And so what we don't compromise is the location, and making an assessment as to not only the location being irreplaceable, but we're asking ourselves, could someone build this again? Could someone compete with this asset in this location over our whole period? And if the answer is yes, then it's a red flag. I think that the second is demand durability. So it's not only about what we're building today, but in development, as you know, a lot of this is around getting in front of the trends and actually building the neighborhood of tomorrow. And so did we believe that there are enough drivers in the area that are making that specific location attractive enough to have us invest our capital? And so we're looking at the type of demand that may occur over 10, 15, 20 years. And so that's going to require a view on demographics, on urbanization, how people are kind of working, living, and consuming within those areas. And so as it's the long game development, you're underwriting this world, again, that doesn't exist. And then third is, I would say from our perspective, it's not only the development on the front end, it's then how do we add value through operations. And that's where being an operator and manager matters enormously for us. We believe that provides us with a competitive advantage. And so, it is around those leasing expertise, the development capability, the asset management depth, like that's everything that we're utilizing and ensuring that the development that we are targeting there is going to be one that works. And then we obviously think about ESG. And so climate resilience, and interestingly or increasingly, an asset that doesn't meet the sustainability thresholds won't be something also that we will spend our time on, because what we have to have clear, resolute on is ensuring that this never becomes a stranded asset, that we're building an asset for the future. And I think we have this across our portfolio. And so I think that's important. I think as it relates to portfolio strategy, whether we're not buying in isolation. So every development decision kind of makes sense in the context of the barbell that I spoke to earlier. So these core irreplaceable assets on the one end, and then these high quality income producing assets on the other. And then across all of this is the conviction and the long-term thesis. And so, we're not developing for next year's market, we're developing for what the market will be in a decade.
Wow, that's a great framework. So after you've identified like a development opportunity that meets all the criteria that you just listed, how do you think about whether you want to execute it alone or bring in a local partner, and what do you look for in a co-investor or partner?
Sure. So, I mean, I would say it's going to be very situation specific. So, St. John's Terminal in New York would have been a great example where we brought CPP in at the front end, partly because the size of the investment was a very large one. 70 Hudson Yards, which we have recently kicked off last year, is another example. It's 1.4 million square feet. It's a very large concentration, and so it's the equity of not only ourselves and our strategic partner Related, but also some LP capital that also is going to be coming along. So it often is driven by the exposure that we may be looking for. And in some cases, it may be a question of we're happy to control it and to sell down in a step two. And we do that often in some other situations, particularly in the asset classes where it may not be as much about size. And so industrial and residential in particular, they're obviously much smaller in terms of scope and size. And so we can endure that ourselves and then decide what the next step may be thereafter. In terms of qualities that we look for in our partners, I mean, it all goes to alignment. Right? We have a number of partners today. We actually manage $16 billion of other people's capital. And so a number of sovereign wealth funds, a number of other pension plans, institutional investors more broadly. And, they look to us to really be that GP capital, but what's distinguishing about us is in many of the cases we tend to be 50-50 with them, or we are at least very substantial equity portions, and that is a very different value proposition that we can offer relative to other developers, right? And so what's unique about us is the fact that we can actually invest as a principal, not only just as a GP, quote unquote.
Yeah, that makes sense. I guess you maybe touch on this, but if you have to say one thing, what is the most important thing you've learned about structuring partnership, and what separates the one that works in real life versus the one that just looks good on paper?
Yeah, it is all about alignment. And so if it's the partners, if you're referring to GP partners, there's one thing. If it's other LP partners that would be with us, it's a slightly different answer, but I would say in all cases it will always come down to alignment. So it's alignment as it relates to the fees, because I think if you show us, how one can make the kind of economic return, we'll show you what the behavior will be, because that in many ways ends up driving one's motivations. I think the other thing is just on the alignment there, and then understanding what the values and the principles may be, and what are those investors looking to achieve. And so I think you can determine right at the front end as to whether or not you're aligned or you're not aligned. And it's the type of capital, right? There are some situations where we are with other long-term capital that doesn't have an end date. There are a couple of situations where we're partnered actually with certain funds that may have a fixed end date. And so we're going into that eyes wide open, knowing that there is a crystallization date that may occur, and we just ensure that we are kind of setting it appropriately at the front end to accommodate anything. The hope in every partnership is candidly that what you've negotiated in that partnership agreement is something that you never have to look back to again. The partnership agreement, though, is something to ensure that when it never actually deals with when things are going well. The partnership agreement has everything to do when things go poorly. And so I think everyone kind of understands that, to understand what the protections are that one has if the investment ends up, unfortunately, going a different direction.
Yeah, that's true. You only look at it when things are not going well.
Yes.
Well, we've talked extensively about what you look for in external parties or external partners. What do you look for when you're building your own team? You recently announced that you're bringing in Sarah Queen.
Yes.
So what makes someone a good fit for Oxford? And what's your approach about assembling your star team?
Yeah, I mean, I had the confidence in coming back because I knew a number of the leaders that were there were people that I trusted, that were exceptionally talented, and that even in the 4.5 years that I was away, there was turnover just like any organization, but I would say that because of COVID and other things that occurred in the time that I've been away, there's probably heightened turnover. But what gave me confidence is the people that I knew that were there were hiring the highest quality people that were going to be in place. What I look for ultimately is just having the depth of team, right? My success is defined by the depth of team that I have working with me. This is not about who may work for me. This is about who I have as partners around the table and making better decisions. And so what I'm constantly trying to assess is, do I have the people around the table that are going to make me a better professional, that are going to drive the organization to the best possible decisions? And so, I think those that are creative is incredibly important. Those that are incredibly hardworking is important. Those that have values that are consistent with my own, right? I'm a family of 5, so I've got 3 children. I try to balance work and family life just as everyone else does. I think that's an important understanding that one may have. And then you need to play well in the sandbox. Like, you are a team player. At the end of the day, this is a team sport, and I think everything that we try to do is ensure that we are surrounded by those that are going to help one another in times of difficulty, and not actually point to when there are mistakes. And I think one of the things that I've tried to do in my return was to try to understand, like, what were the lessons learned over the course of the last few years? Because I think there were a lot, right? We've endured between COVID, then parlaying that into the rate rise that we've seen, then parlaying that into the geopolitical tensions that we've seen coming off that. Like, it has been a very difficult market and environment in which to invest. And so I think having that mix of people around the table that that you can rely on, and that that is going to offer unvarnished views and great contributions to the conversation, that's what you ultimately want from your team.
Wow, so well said. I think that's a great advice for anyone listening to this podcast. I guess I wanted to shift gears a little bit and talk about the future of office assets. Oxford has obviously developed and invested in some of the most ambitious office projects around the world. And many of your peers have been pulling back on office. CPPIB sold you their stake in 3 properties in Calgary and 4 in Vancouver. Yes. In your opinion, what's like the fundamental investment thesis for trophy class office right now?
Sure. And I'll start with the CPP transaction, because I think it actually illustrates the thesis better than anything that I can say abstractly. And so we acquired those assets because we had genuine conviction in high quality, well located office. Right? And what we're seeing across our portfolio is a tale of 2 markets. So you've got truly trophy, amenity-rich, transit-connected office in the right locations is performing extremely well. And then you have others that are not. And so among this specific subset of assets, vacancy is low, rents are growing. Outside of that, it's a very, very different story. And so I think the negative headlines that we're seeing about the sector since 2020 with COVID, then work from home, and now AI means that investors are certainly tarring the entire sector with the same brush. And what makes it a bit different for Oxford is that we were also a net seller of office actually leading up to this. And so over the course of, even from the time that I started in 2011, we sold a fair amount of office in Canada. I would say that if you looked at what we did from 2018 on, we began to, again, similarly actually sell down a fair amount of our office. And so that was partly a view that we were looking to diversify our asset base, and office was being very well bid. If I reflect back on the market in 2019, I mean, it was in Toronto and in Vancouver in particular, those markets were sub 3% vacancy. They were some of the tightest markets in the world. And so we took the opportunity in different places to kind of crystallize value, and we knew we had a development pipeline that we could replace some of those great assets with other newer great assets. So office has always been part of our DNA, and our view was, now having recycled out of some of that capital, and now because there's been a reset, and we can see within our own leasing of these high quality office assets, like that's the place in which we should be investing some of our capital. So that CPP transaction, it was all about knowing those assets incredibly well how well positioned they were in the market. And so if you look at the Vancouver portfolio in particular, I mean, you're talking about assets that have single digit vacancy within our portfolio against a market backdrop that is 15% or so.
Yeah.
In Calgary, it's the same thing. It's actually closer to 30%. And so that one we just led with conviction, and we were buying it at a basis that we were very comfortable in understanding. And it was a win-win for both of us. I mean, CPP is a great partner of ours, a strategic partner of ours, both in Canada and globally. And this made all the sense for them for different reasons. And so I think that's the beauty of what makes a market. You've got, parties on either side.
Great. Well, you kind of touched on this earlier, but I'm curious to hear your thoughts on AI potentially disrupting the future of workspaces and how that changes your investment thesis maybe going forward with office.
Yeah, I mean, I think that story is still being written, right? I think there is still a lot that needs to be determined on the impact of AI. I think there's clearly going to be some impact, but I think the impact is not going to be equal. Like, it will impact the second set of assets that I spoke to that are not the trophy, amenity rich, irreplaceable assets. They will continue to have a place, and we see that within the leasing program today, where frankly, that's where all the tenant demand is. That's what gave us the conviction to move ahead with 70 Hudson Yards. We now have Deloitte as the tenant in tow that's representing 60% of it. We're seeing some great leasing traction there. And across our portfolio, I mean, I would say even in a Canadian sense, we were going through our own budget. We have kind of surpassed north of 80% of our leasing budget in office through the first quarter of this year. And so I think when you speak to just the fundamentals, if you own great quality office assets, you're going to get. Will it have an impact? Absolutely. And I think what we're trying to understand is when that starts to tip the other way, because everything that we've seen in terms of AI has been more around productivity improvements and has been less around less hours worked, and you haven't seen the impact on the labor force right now. So there's obviously the correlation of job growth to office, but I think if you're owning the best quality assets, those will continue to handle well. You just need to make sure that you own the right product in the right markets.
Yeah. Okay, let's end with something forward-looking. Obviously, you stepped into the CEO's role at a time where the rates are shifting and there's a lot of geopolitical uncertainty, and also the tariff dynamics just creating new frictions between Canada, U.S. capital flow. How does Oxford navigate through this period of turbulence, and what does the next chapter of Oxford look like for you?
Well, in some ways, I thought that I was timing my return to Oxford perfectly. I was like, we were seeing some kind of stability in some areas. I joined in late November, and then all of a sudden, we started with Venezuela, then we started with the Middle East conflict, and so the timing may not have been as great as I thought it was. But we've seen cycles before. This is not new. I think the playbook in uncertainty remains the same, which is stay focused on the things that you can control, or at least have greater control on, and trust your strategy. So I try to remind our teams that things work when our buildings are well leased, when our customers within those buildings are happy and they're renewing and they're able to make some of the decisions. And so I think that's what we've been trying to impress upon everyone is like, there's a lot that's happening, by the way, not only professionally where it's become more complicated investing, but it's also been personally for a lot of people where this has touched, a lot of people personally where it's difficult to see what's happening and to navigate, what may be happening. So real estate is relatively well positioned now. And I think this is the other thing that we've tried to share with the teams, which is compared to other asset classes, we are fairly priced, and we've gone through a repricing exercise already. This rate impact made the last number of years quite difficult. Last year was actually Oxford's first positive return in a few years, and so we feel like we've kind of turned the corner, and things keep getting a little bit better. We also see lending conditions that have improved and that are still very constructive for transaction activity. So taken together, I think these shifts signal that we're entering a more favorable phase of the real estate market. So if you look at from April of 22 to the beginning of this year, you had gold that was up over 200%. You had S&P 500 that was up over 65%, and private real estate was down 15 to 20%. So on a relative value basis, we actually think we have seen the worst behind us. And so we're really focused on the kind of next step. And so I think we also would say that real estate, unlike other asset classes, because of the lot size of them, so on the industrial side, on the resi side, when you're selling $30 million a pop of some of these assets, you can seek liquidity in a very different way. And so we've actually been able to generate liquidity of a few $1 billion over the last couple of years. And we've done so in situations where we're not a distressed seller, but where it makes sense and where we can still crystallize an appropriate return, we've been happy to do so. And I would say that we're seeing that this year as well, particularly in North America. I'd say, we're starting to see it a little bit more challenging in Europe and in Asia Pacific in terms of where the difficulty is in selling. But I would say in North America sense, it's been great. So, this next chapter of Oxford will really be defined by us going deeper into the asset classes and to the markets that we know, where we believe that we have expertise that is unrivaled, and where we believe that we can compete. And so if we can't be a top quartile winner in some of these strategies, and if they're not scalable, we just are beginning to look at some of those other areas and saying, okay, well, that may be more a distraction. Let's move off of some of those. And we're trying to narrow the number of places in which we focus our capital. So, I'd like to say I'm genuinely optimistic. I voted with my feet. I feel like this platform, where you have the in-the-box leasing, asset management, development, operations, that's going to help define the winners of tomorrow. And I think Oxford is very well positioned for that.
Very well said. It sounds like there's light at the end of the tunnel finally.
We're closer to the light at the end of the tunnel than anyone thinks.
Okay, well, Eric, this has been an incredible conversation. Thank you so much for taking the time to share your perspective with us. I know our listeners are going to get a lot out of this. And that's it for today's episode of Meet the Visionaries from MIT Center for Real Estate. Thank you for tuning in, and we'll see you next time.
Thank you for the invite. It's been tremendous.